Hello everyone, welcome. This is Desi Vijay. I'm a North-South National team member and a coordinator for webinars. Hope you're all enjoying this holiday season and glad to see you all here today. As the year 2023 is winding down, we are bringing you today an important topic to help you take care of some financial matters before it really ends. We are really pleased to have three financial experts here to talk to you in plain English and educate you on that topic. I'm really glad that we are able to bring this topic today on the right time, and welcome for yet another exciting webinar session. But before we go any further, I just want to get the housekeeping comments out of the way. This webinar is being recorded as we speak, and we will send you a link in a day or two. As you know, some of our past webinars are also available in our North-South YouTube channel. Please subscribe to YouTube channel and then watch them at your leisure. If you have any questions to ask for the speakers, please type them out in the questions or chat tab you have. We will collect them after all the presentations are over and ask the speakers on your behalf, and then they would respond to your questions. Please, we will try to ask the questions that we receive them. So please don't keep on repeating the same questions over and over again, and that makes our thing harder. Thank you for your understanding, and then please free to ask any questions you want to pose to the presenters. Before you leave, please take a moment to fill in the feedback questions. That is important to us as well as the presenters to figure out how they did today, and then that will help us formulate ours further. Finally, I really want to thank this opportunity for a successful webinar series thus far. We have been trying to do, bring in all the experts and trying to do the best we can, and to educate you, to engage you, and then to bring you the diversified topics. So if you think you have some suggestions as to the topic we should talk about, or if you know somebody who could really be a good presenter for these webinars, please just let us know at webinars@northsouth.org, and we will take that up further and pursue it. And thanks for all your help. If you can be a presenter also, that's welcome. Please just let us know. Let's move on to the main program. Today we are going to talk about 2023 year-end financial planning for individuals and small business owners. We have, as I said, very dedicated financial planning professionals here with us today. Just agreed to spend their time with us, though it's a busy time for them. And it gives me a great pleasure to welcome Jyoti Sharhati, Praveen Anartula, and Kumar Bachu here to help us understand all these intricacies of financial planning. Jyoti, who has provided a webinar for us before, is a licensed financial planner and a senior marketing director based in Chicago area. She has been advising families on personal finance topics by hosting several webinar sessions through organizations and communities. She's licensed in Illinois and also in multiple states. Professionally also, she's working as a software industry, and she's basically an engineer. Praveena, who was also here before, is also a licensed financial planner and marketing director. He is based on Boston area and advising families on personal finance topics by hosting several sessions through the organizations and communities. He is licensed in Massachusetts and several other states, and he is certified college counseling. He has studied mechanical engineering with MBA and also a director in a multinational corporation. We have Mr. Kumar Bachu here. He's joining us from Dallas, and he's an enrolled agent admitted to the practice before the IRS and is a partner in Right TaxMate. He comes with a diverse background and interest in finance. Kumar specializes advising clients on tax-saving strategies, repatriations of funds, and from other U.S. international compliances, asset protections, transfer of wealth to the next generation, and estate planning. For small and medium business also, he advises on the business structure, cost management, and tax case savings, everything. So we really fortunate to have all these three willing to talk to us and then answer all your questions. So let me welcome you all three on your behalf for this session. And let's start with Jyoti. Here you are, Jyoti.
Okay, thank you. Thanks, Vijay, for a lovely introduction. So, hello everyone. My name is Jyoti, and I know we are thanks to NSF organization for letting us do the education. So we do conduct financial education webinars, and we would like to educate you and then give you a proper guidance so then you make a right decision. So today we're going to talk about a few topics on the year-end checklist, like financial, what you need to be checking at. This is a good time to think over and see where are you in a right track for all the financial and tax. So with that, today's topic, my topic, I'm going to cover about the retirement planning. So again, disclaimer, we always say that we do the education, you do the right decision for yourself, what's good for you, for your family. We just bring you education on different topics. So again, we believe in a financial education as a NSF organization does. We do the same thing. So as a we want you to educate. So more the more you can know your money will work for you. So we do several educational workshops. We do also one-on-one financial review checklist, all complimentary. We don't charge anybody. It's a fully voluntary we do, and not forcing you to buy anything, something which is not appropriate for you. We would bring the education on table and then, on different topics, like health insurance, long-term care, Medicare, life insurance, visitor insurance, estate planning, social security optimization, and the investments and college planning and annuities, which I'm going to cover. So also we have a WhatsApp group. We have if you guys want to join, attend our webinars, you are free to join and get educated. Also, you want to talk about, if you don't have a time to attend any of our webinars, you want to have us to help you understand one of the topics, any areas you're interested, you can always reach out to us. We are all in the WhatsApp group, so you guys join, feel free to join. If you want to stay and then learn about it, learn. Also, you want to have a one-on-one session, let us know as well. And here is a QR code you could scan, so you can directly join the WhatsApp group, or if you want us to contact us and one of us, you let us know, we will add you in the group. So with that, I'm going to talk about what's retirement planning. So, most of us, this is a time we check our statements, right? Oh, how is my 401k doing? Also, what's my social security? How much I'm in the right track? Do I have enough credits? What will my social security amount will be when I retire? So most of us, because this is a time we can think about it, right? Not the time we cannot think at the older age, right? So right now, lay the foundation, see where you are, and are we in a right vehicle, right plans in place, right? So 401k also, it's always good to log in, check, make sure beneficiaries are there, make sure you are in putting in the right allocations. So that's a retirement planning. So also when we think about retirement planning, we need to focus on, okay, right now when I'm retired 60 or 65, where is my income is going to come? Is it enough for me to live as long as I can have enough source of retirement in those vehicles where I am currently contributing? Always to have a checklist. And also look about the Medicare when you enroll into Medicare when you're 65. So it's not just a free medical insurance, right? Also need to know who qualify for this, and then how much I'm going to pay for the supplement, Medicare supplements, who pays for it if I don't have income. Also understand about the cost involved in the long-term care. Do I have enough assets to cover my long-term care cost? So In olden days, we need to have a pension. We used to have a pension from the companies, so that you have a, when you retired, you will have a lifetime income, so that you have a social security, you have a pension. It's a good, safe retirement we used to have in the past. Nowadays, the pension are taking away from the companies because people are living longer, and then people think they cannot afford to pay for the longer durations, right? So that's why now 401k got introduced, replacing the pension. So we know that most people, it's not mandatory to contribute in 401k. People can opt in or opt out, right? So pension is something companies to give by default. But nowadays, people, when even the for a 401k, we don't really, not everybody contributes. Most of when they're starting new, right? They always think. Can you guys see my screen?
Yes.
Okay.
Sure.
So always think, oh, I will contribute, later, right now I don't have a money to contribute my 401k, right? So it's, always, we always advise, start early, some amount anyway, you are, if you are making certain income, right, distribute some portion goes to your retirement. So that's what, you need to look about the retirement vehicle. There are multiple options available for you to contribute. Start thinking about retirement. Also, why plan retirement early? Because we know that there are certain things which you don't have in control, right? The cost of living, medical expenses, and legal issues, paying the taxes, those things, right? Something somewhere we don't have a control. So that's why we need to start thinking about plan early on the retirement. Also with the inflation, right? So we know that right now with the last year, it was inflation was high inflation. With the inflation, right, we cannot control on the inflation. How much we need for what we need from now in future, it may not be enough for us, right? So let's say it could affect many things: market, health, cost of living, right, taxes. So also when you need a, let's say you are in a, if even though it's in a 3% inflation rate, if you need a, $50,000 for annual expenses now, but in 10 year down the line, you may have a 60,000, 67k per year, right, for the cost of living. So it might, raising cost of, we have a challenge of, how the cost is going to increase retirement cost with the inflation. And people always worried about, they're not worried about dying too soon. They're most worried about, what if I'm outliving my money, if I am not doesn't have enough money for my retirement. That's what more people are fear about, right? Always we fear about, oh, what happens if I get into any health situation, or another thing is, what happens if I don't have enough money if I live long. So that's what most people about fear about it. So we have a different retirement income sources. Most of us, commonly know that 401k is the only vehicle, but some companies, like only 10% of the companies do have pensions. You can distribute into different retirement income sources, like Roth IRA, also one of the vehicle where you can have a flexible income. And some people have a 401k, they have a switch in the company, they can convert that one into IRA. And also there is a, if you're starting early, there is a cash value life insurance can be used as a supplemental retirement income. Those are flexible income. Whereas a lifetime income, you have a social security, if no pension, there is a annuities can be your supplemental lifetime income option for you on a retirement. So again, people are going to live longer. So at the, this is a prediction that, at the age, female who are 65, right now, there is a 50% chance of that they're going to live at the age of 88. And the male who's going to, right now at the 65, chance of living up to 85. So there is a, we are, people retire from 67 to 85 or, 90, right? So how we are protecting our assets and where we are having income. Always we say diversification. So when you are retirement folio, you need a 1 million, right? So diversify with the, putting into the annuities is advisable. We say that, okay, put 40% into annuities and put 60% into your risk portfolio, where you can have a, take the risk and go beat the market, but another 40% put it in the protected place where you don't lose money based on the market. That's called the annuity. and set for some guaranteed income. Basic expense, right? Let's say somebody need a $5,000 per month. So basic that amount, how do you achieve it, and what kind of annuity, how much you need for that. So that's what they, determining, having something flexible, right? Guaranteed lifetime income with the basic cover expenditure. So that's called the annuities. So, there are, it's too much, too less time I have to cover on the most on the annuities. So definitely you guys can study on your own and find out this is another vehicle of your supplemental retirement. There are all types of annuities we do. Again, you can start the annuity, as soon as you're born also you can start, and there are some people can start at the later also, or some people have a 401ks you can roll over, or some people have a cash sitting on a bank you want to set aside annuities. We do annuities also. You can have annuities at any age. Annuities is something, it's the opposite of a life insurance. Where the life insurance, there is a death benefit will pay out to the in a big amount, you paying a monthly premium, whereas the annuities you pay some lump sum and put it there and you get the pay as long as you live. That's the annuities. So there is a lifetime income options you can have. And the benefit of the annuities are your principal is protected, you will never lose your money, and also you have an income protection, you have a death benefit protection. There is always need to think about, when you're investing any annuities, what type of annuities. There are many kinds of annuities available. People had an wrong impression of, oh, annuities doesn't work because they were putting in a wrong type of annuities. So there are where your principal should be protected. There are different kinds of annuities, so you need to understand, based on your you want to take a risk and put it in annuity with the charges, no charges. So we do educate individually on these things, and depending on the wage, depending on the amount. So you need to understand these are the questions you need to ask, where you want to be in the market. So we like to, we can help you to choose, or we will help you to educate. So then you take a decision which company, where you want to go. Yeah. So again, immediate annuities where you want to, some people, later in the game, right, like 65, 70, they have, then we go into the immediate annuity where they want to turn on the income. So you can have it also. There is a fixed index in it. Annuities we do have right now, the better than the banks. There is a guaranteed, interest you're going to get on the fixed index annuities. Also, there is a variable annuities. If some people are young and they want to choose a variable annuities instead of into stock, they lose it when there is a negative. The variable annuities, you can protect your principal, but then you can in the stock and where you gain the growth when the market does. And again, it's annuity is the retirement vehicle where you cannot take out the money before 15 and a half, and it's the tax deferred. When you take out, you have to pay tax. Again, you can talk to Kumar on that about the tax, how the tax implications on these kind of products. So fixed index annuity is the most popular right now. It has principal protection, guaranteed income, and also death benefit, access to your money, and the tax deferral. So these are the few points, to choose which annuity is right for you. I know I'm running out of time, and also you in the annuities you can have a riders also, where you can have a long-term care rider to add it to the annuities, where you want to, if you want to take out the money for the long-term care through the annuities, you could add a couple of riders into the annuities as well. So with that, of course, any questions you guys have, you can always put it in a chat window, and I'm happy to address any of the annuities questions. And annuities is one of the vehicle where you could have a supplemental retirement income for your portfolio when you're planning for your retirement. So with that, I will pass it on to Pravina. He's going to cover about the financial checklist on the year-end finance checklist. So with that, over to you, Praveen.
Morning, good afternoon. Thanks for making time to join us. Sorry, we'll switch the panelist with a present.
Yeah, I will make a presenter now. Okay. Yeah.
Everyone for making it.
Presentation mode. Yeah.
I think it took back. Can I?
We can see your screen.
Yeah.
But yeah, you can put it in a presentation. Yeah,
Everyone,
Perfect. Yeah.
thanks everyone for making time today. So I know the holidays in the next few days you'll be attending different social gatherings and other things. So if you bring up the financial planning, and obviously people talk about it, almost always, at least my experiences, we talk about our investment, whether it's Google stock, whether it's Amazon stock, the Bitcoins and other things. Rarely we talk about the foundation that is needed. So that's why we emphasize on, when you think about financial planning, it's like building the house, start with the foundations, right? So as a year-end checklist, we make sure that you focus on the proper protection needed. So as you know, in the Indian community, you always get these messages about, GoFundMe and help this family because, something happened. We don't want anybody in that situation. So we help the community with that. So whenever you think about financial planning, there are four things, right? So one is you start with the protections and debt management. Generally, Indian communities is putting that, and then having an emergency fund. We recommend to have a money available in case of an emergency. Let's say 6 months worth of your expenses. So that is in a place where you can access. So if you think about 401k investment, so that is not an emergency fund because you're putting that away for a long term. And if you have completed all the steps, then we talk to you about the investment and what you can do there. So when you talk about protection, there are four kinds of protection. So one is about health. The second one is life. The third one is serious illness, and fourth one is about asset protection, so that's estate planning. So I spend a little bit more time on the long-term care because when we talk to different families, so we talked to over 2,000 families in the last 3-4 years. So one thing we always notice is a long-term care. This is something there is very little awareness in the Indian community. So we take time to explain that. So one thing about long-term care, to understand what the concept is, if you think about daily living activities like bathing, dressing, eating, continence, toileting, moving in and out of bed, you expect that everybody to do, and then if people cannot do that, then it's called long-term care situation. So generally people think, okay, I'm healthy. What are the chances I will come across this? You never know. So if you look at statistically, people over the age 65, 70% of the people will have some kind of long-term care service in their lifetime. Other thing what is concerning is 4 out of 10 people between the age of 18 and 64 will have long-term care situation. Now, we know that healthcare is expensive in US. So if you think about a minimum care, somebody coming and helping few hours a day, it could cost 25,000 versus the other end, which is a private room in the nursing home. It could cost up to 100,000, right? Again, this is a national average. If you're in a high cost area, whether it is Dallas or Chicago or Boston, numbers will be much, right? And the misconception is, everybody thinks if something happens to health, we have health insurance cover. That is not true. So if we have health insurance, it covers for health situation, not for long-term care situation. Then the other thing is Medicare. It will cover for the people over the age 65, only 100 days of hospitalization, that too after 3 days of hospital stay. And then Medicaid is for people with very limited income. So needless to say, you won't get the coverage if you're not covered through other means. So then we always say, what is the best way then to cover for the long-term care? So one way to do that is to go for a life insurance policy where you can buy riders. Riders are like you buy a basic product, then you can add, this is almost like, buy one get one free kind of things. So you get the life insurance and say, I want to get long-term care as my rider, so you can get that too. The second one is you buy a financial product. There are a lot of different things you can buy and say. Sometimes they say, oh, do you want to get a long-term care rider? What it is sometimes instead of getting 100% of the payment, you will get 150% or 200% of the payment if somebody's in a long-term care situation. So the third way of getting that is a standalone policy that could be expensive depending on the age. So we always say, as year-end checklist, think about you can protect yourself or from the health perspective, it's a long-term care. The second protection is a life insurance. Life insurance concept is easy to understand. So those who grew up in India, so we know life insurance. In the US is pretty complex again. So you have term life insurance and then your permanent life insurance. It's always a question of how much insurance I should have, how do I, and how long I need the protection. All the different questions comes up. So as a rule of thumb, we give this formula 10-20. What it is if you're making 100,000, so we say you should have a protection worth of 10 times that, which will be $1 million, right? So people always ask, how much money I should have when I retire? So we say it's 20 times your income. So if you're making 100,000, so target to have about 2 million when you retire. So again, everybody's situation is different. It varies from person to person, but you can take that as a starting point for your plan. In the case of insurance, so I talked about term life insurance. So term life insurance is very much like car insurance, right? So you decide how long you need it and what's the amount. And you pay the premium. There's no flexibility there. As long as you're paying, after that period, you're covered. So it's tend to be cheaper. You don't get anything back, right? So then you can take it for 5-year protection, 10-year protection, 20-year protection. That's up to what you decide. Then there are group term is typically like what you get through your work. There is no health check or anything. They provide, 1 times your annual income or 2 times you can get extra by paying. The second type is called permanent life, where small amount of payment that you send will go towards your term life insurance. The rest of the money gets invested. So earlier, Jyotiji was talking about, you can have retirement income through this. So this is very attractive because income comes tax-free. So there are 4 kinds of permanent life insurance: whole life, universal, variable universal, and index. I won't go through detail those 3. The first one is whole life is you buy insurance, let's say $1 million, and the insurance company will say how much you have to pay. You pay 10,000 for the next 30 years. You know what growth rate will be. Everything is fixed here. So you have to pay the fixed amount every year for a date, and then after the period, you'll get the benefit of that. So in the case of universal life, it is similar concept, except the money gets invested in interest yielding financial products. So your growth could be 2%, 5%, 7%, 10%, depending on how those are performing. Variable universal life is very, very similar to your 401k plan. So there is funds available. You invest in different funds. So if you're lucky, if the market is performing well, you may have growth in that. If the market is not doing well, you won't grow the money. So what happened is in 2008, market crash happened. So a lot of people had variable universal life. The primary purpose of this is to protect ourselves as well as growing the money. So if you have 40-50% correction, what good is that money, right? So that's where the insurance industry came up with what is called as index universal life. In this case, they built in a protection to say, no matter what happens to the market, you will make a minimum floor amount, typically like 0.75% or 1%. Like last year, if you're in the S&P 500, market went down by about 20%, right? So if you had this index universal life, you still made 0.75. On the other side, they put a cap to say this is the highest you can make. It could be 12%, 13%, 15%. So if the market has performed 10%, you get 10%. If the market has performed 20%, you still get 13% because that's a cap. So the benefit of this is no matter what happens to the market, you're still growing the money, but the money is in the market. So the chances are, if you look at 4, 5, 10-year period, there is always corrections, but better years are more than correction years. So because of that, you're always growing the money. You grow higher amount, sometimes you grow lower amount. So growth is there, the safety is there. The third thing is, again, this is an insurance product. Your primary purpose of this is to get the insurance. So I've got an illustration here. So you took a insurance for $1 million. If something happens to the policyholder, you get the $1 million plus any cash growth that happened during that time. So if somebody started investing, took the $1 million insurance and start paying this up to the age 65, started at the age 30, they could potentially have 1.24 million in cash. This is your money, right? It's a tax-free withdrawal. You can use it for anything. And if something happens to that person at age 65, then the family get 2.25 million, right? You're also protected with, I was talking about the rider with the long-term care. You could have long-term care and also the living benefit. I'll talk about living benefit in a second. And the best thing is it's tax advantage. The money that you're drawn, you're not paying taxes on that. So any investment you make, you have to think from the 4 different perspectives. One is growth, safety, protection, and tax advantage. This is one of the things really get all 4. Right? If you think about 401k, you have growth because it's invested in the market. You don't have a safety, right? You don't have protection, but you have tax advantage. So think about anything you do. Think from these 4, different angles, and see whether the money grows, whether it gives the protection, whether you have tax advantages. The third thing we talk about from the protection standpoint is living benefit. So everybody thinks, hey, if I have life insurance, if something happens to the policyholder, family will get the benefit. What if the person is still alive but going through either critical illness, chronic illness, or terminal illness? So then we suggest to take this protection called rider when you buy your protection through insurance policies. If you have the living benefit rider, then you can draw the money from the policy while the person is still alive and pay for the treatment, pay for the living expenses. So when the family is going through a lot, if there is a critical illness situation, terminal illness situation, the last thing the family has to worry about is money. By having this, you're protecting the family. And the 4th part of the protection is asset planning, estate planning. So we know that many of us who grew up in India, so for us the inheritance is automatic, right? So you don't have to think much about, do we need a will, do we need a trust? But in this country, it's very different. So if you don't have any documentation, it goes through what is called as probate process. So assets get distributed only after going through the probate process. And if you have minor kids, then guardianship is decided by the probate court. So it takes a long time to go through this process to get the benefit, get the money, and get the protection. So that's why we always say, as you think about your year-end checklist, think about the estate planning. It is very easy to get it done. So we help families, or you can talk to people that you know. When you do your estate planning, we always suggest take care of 5 things. Have a will, have a trust, have a durable power of attorney so that you authorize someone else to make the financial decision. Have a advanced medical directive, it's also known as healthcare proxy, where you authorize somebody else to make the medical decision if you are incapacitated. And the 5th one is HIPAA release. This is the medical record releases. So if you own a business, we always say think about the succession plan, and if there is special needs kids or any of those situations, think about irrevocable trust. Again, I won't go through this detail, but you can see that having no documentation, then you have to go through probate process. All information about the asset is public. Then you spend money anywhere from 5 to 20% of the value of the assets through probate process. It takes time. like in the state of Massachusetts, it could take anywhere from 60 months to 2 years to resolve a probate case. Most of the states are backed up after the pandemic, so it takes time. So if you have a will, it helps, but you still need to go through a lot of these processes. That's why we suggest to form the trust. So think about your situation and think about what you can get done. When you're talking about the protection and the, Jyoti ji talked about retirement benefit. So one other thing I want to touch is the Social Security benefit, because almost all of us, when we're working, we pay Social Security, but it's complex to understand, what benefit we will get out of that. So there are 2,700 rules in the Social Security, and there are early retirement, there is full benefit, there is delayed retirement. So all those rules are different. So we suggest that if you're above the age 50, first go and establish your Social Security account. You can go there and see and talk to a financial professional. Some people say, I want to retire at 60, I want to retire at 62. How does your Social Security varies based on, your retirement age? And the other thing is the spousal benefit, survivor benefit, all the special situations, dependent benefits are different. You need to understand that. So in 2023, if you think about Social Security benefits, the inflation was high, so they adjust your payment based on the inflation. Last year was one of the biggest increases, 8.7% increase. It's called cost of living adjustment. You hear the term COLA in the TV and radio, so that's about adjustment based on the inflation. So when you're in earning, so there is the earning limit up to which you'll be taxed. So every year it get adjusted. So in 2023 it was 160,200. What it means is if you make 200,000, your first 160,000 of the income is taxed for Social Security. And 2024 it's going to be increased to 168,600, right? So every year it goes up, it gets adjusted by inflation and other factors. So the FICA, so that's the contribution we make towards that. There is 6.2% it goes towards Social Security, and 1.45% goes to Medicare. So all this contribution you make is matched by employer contribution. So that much money goes to Social Security. How do you earn? So if you earn more than $1,510, gives you 1 credit. If you earn more than 6,014 in a year, it gives you 4 credit. So if you have 40 credits, you are eligible to receive the Social Security. And the calculation is pretty complex. I'll not go through the full calculation of that. So what it is what you get on a monthly basis is called primary insurance amount. So it's based on 35 years of your wages, your income. So if you work for, let's say, 30 years, then the other 5 years will be calculated as 0. So if you work 10 years, you still get the benefits, but the other 25 years will be 0 towards the calculation. In 2023, so they also cap how much benefit you can get. The maximum you could get if you waited for the delayed retirement would have been 4,555. So if you waited for the full retirement, typically around 67, you would have got 3,627. If you took the early retirement, it would have been about 2,572. So you can see the big difference, about 70% difference between if you wait for the delayed retirement versus early retirement, and the average Social Security is 1,800. So it's an interesting topic. Whether you cannot do anything unless one thing you can do is, if this is part of your retirement income, you can decide when you can retire, right? So a lot of people has this dilemma: do I retire at 62, by 67, or 70? You can decide on that based on this. So with that, I will hand over to Kumar. He'll be talking about the year-end tax activities.
Thank you, Praveen. Vijay, can you make me the presenter?
Yeah, I'm making you a presenter.
Okay.
Did you accept? Okay, good.
You're able to see my screen?
Yeah, I can see a screen. You can go to the presentation mode to.
Yeah.
Okay.
Thank you, Vijay. Thank you for making the presentation. Jyoti, thank you for the overview on the financial. Praveen and Jyoti, thank you for the overview on the financials. So I'll be talking today on tax. I'll be covering few topics. I think a little bit less time is available. So based on the time, we will see what to take out of this, but I will touch base on most of the topics here. So we'll quickly talk about our credentials. I will touch base on the updates from IRS. We will talk a little bit about individual tax. What are the tax saving strategies for individuals? We'll talk about small business tax saving opportunities. EV credit has been one of the questions that I keep on getting, especially at this time of the year. What kind of credits are available? We'll touch base on EV credits. We will touch base on international compliance, which is FBAR and FATCA. I will also put out our contact details towards the end. And if you have any questions, you can always reach out to us. A little bit of our background. We are a team of about 75 tax consultants. We are a team of EAs, CPAs, and tax associates. We provide bookkeeping, payroll, and individual tax services. We have offices across US. Our main office and corporate office is in Houston. We have 2 offices in Dallas. We have an office in Chicago, and we are yet to open an office in Seattle. We'll be opening a new office in Seattle in January 2023. One of the key differentiators for us is technology. We use top-of-the-line tax software, and we use a very secure client portal. All of your communication, all of your documents go through a client portal. We do not encourage you to share any of the documents through email, specifically, client-sensitive information documents. We do not encourage to use email. You have an account for yourself in the client portal, and in the client portal, you can always upload all the documents. In the last year, we have done more than 3,000 plus individual and business taxes. We do about 350 plus bookkeeping, and we have provided services to 100 plus auditing. So we have a huge client base. Our key vision is to be a trusted partner in tax bookkeeping and payroll for you. We would want to add value when you come to us. That's one of the key areas that we focus on. So some of the updates from IRS. We have been hearing about IRS doing a lot of investment in the last year. So federal government allocated about $80 billion to IRS. So what does it mean for you when that money is being pumped into IRS? Now, the money of $80 billion is split into 2 trunks, or 2 segments. A $35 billion will be used to upgrade IRS operations. So one of the key initiatives of this upgrade to IRS operations is going paperless. 2024 onwards, a lot of correspondence, what you are seeing today on paper, will become digital. You will start getting notices, non-tax forms, everything on your email. So there will be no more paper. IRS is also looking at making paperless processing from 2025, which basically means that today, if you have to file your tax returns for 2020 or 2 years before, you will have to make a paper filing. So from 2025 onwards, any filings that you need to do with IRS can be filed, no more paper. The $45 billion of the $80 billion is earmarked for enforcement. What does it mean to you? The number of revenue officers actually will increase. Audit rates are expected to go up, and IRS is able to focus on few areas, key areas: cryptocurrency, S corporation compensation, offshore accounts, easements, and some business partnerships. IRS is also increasing its focus on international compliance. So basically, if you have foreign income and if you have some assets outside of US, you are expected to disclose through FBAR and FATCA. Now, for all these operations, IRS has selected Rajiv Uppal as the Chief Information Officer. So he has known to, transform IT operations earlier, and you can expect these changes in IRS to be effective very soon. So there are a few updates in HSA, Roth IRA and 401k, which I think you should be aware for 2023. These 401k, HSA and Roth are inflation adjusted, which means every year they keep on changing. For 2023, the maximum contributions for 401k is 22,500, for HSA is 7,500, and for Roth IRA it is 6,500. Now the filing due dates for 2023 IRS has announced. For pass-through business entities, it is 15th March 2024, and for C Corporation individuals and FBAR FATCA, the deadline is 15th April 2024. We'll touch base on individuals. As I said earlier, the tax brackets in US is graded. So basically, and it's inflation adjusted. So it's graded in the sense that your tax keeps on increasing as your income increases. So most of our Indians fall in the 22 to 35% bracket. If you see the difference between 22 and 23, there is a difference, significant difference due to inflation adjustments, which basically means that for 22% tax bracket in 2023, you should have at least earned around 89,000. But last year, the same 22% bracket started at 83,000. So there's just a figure just for you to understand that there is a change in the brackets. If you need more information, you can always go to IRS website to see what is your bracket and where you're falling. So some of the tax saving tips for individuals. So these are all very specific to each individual. Please talk to your CPA or your tax attorney or tax consultant. They will be able to look at your specific scenario situation and will be able to help you understand whether it is applicable for you. But I'm just going to bring out few of the things which will make you aware of what advantages you can take to save some taxes. Now, if you have a foreign rental property or a property outside of US, declare the property in the US individual return and take advantage of any travel. So if you are traveling, for example, if you have a rental property in India and you declare the rental property in US tax returns, if you travel to India in a year, at least once a year travel can be expensed during your tax filing. Now we have a traditional to Roth IRA conversion possibility. So please convert your traditional IRA into Roth. Roth grows tax-free. So when you do a conversion from traditional to Roth, you may have to pay some taxes, but any growth in future is going to be tax-free. You can contribute to your HSA and invest. A lot of us know that HSA is a way in which you can contribute pre-tax dollars, and people think that it can be only used for health savings or health expenses. It is not true. You can invest in a HSA account. You can go and invest in stock market. You can go and invest in CDs. And so please do take advantage of this HSA opportunity, contribute to HSA, and do your investment and grow it tax-free. So there are some advantages of kiddie tax. So if your kids are having interest, they fall in a different bracket. See how you can change some of the FDs what you have or investments that you have done in your name and move some of that investment to returns to kids. So they will have a lower tax and you will be able to take advantage of the kiddie tax. You can do some refund faster if you file earlier. So please file earlier, get the refund and do the investment. There are a few other opportunities that are there. I will not go into details, and if you need some clarifications or opportunities, you can always reach out to us or to your tax preparer. So small business, I'll touch base on small business. There are multiple ways in which you can open a small business. All of you are aware of sole proprietor, C corporation, S corporation, and partnership. Just wanted to touch base on the different types of businesses that are available in US. A lot of people think that a specific type of a business or an entity can take tax advantage. It is not so. Any of the business what you have set up, whether it's a sole proprietor, C corporation, S corporation, or partnership, can take all the tax strategies or tax saving opportunities, which I'm going to talk in the next slide. There are some differences between these two. Each of these entity is dependent on specific scenario. And if you want to know what is the best entity structure for your small business, please reach out to your tax consultant. They will be able to help you. Now, every small business has, QBI deduction except the C corporation. So you take advantage and maximize the 20% qualified business income deduction what you get. In some of the entity structures, you will be able to do, or in every entity structure, you'll be able to make a spouse as a business partner, and you'll be able to get some passive income for the spouse. Use this passive income to offset any passive losses what you have in other areas. You can maximize your pre-tax deductions by opening a retirement account or a healthcare premium account. We'll talk about a little bit different types of retirement accounts in the next slide. You can contribute to the pre-tax dollars and save them. You can maximize on the home office expenses, especially if you're working from home. You should be able to claim home office expenses. Please use that home office expenses, maximize your expenses, and reduce your business income. You can buy a vehicle for business and expense that. You can use the business vehicle for depreciating, and also you can use the gas and any maintenance what you do for the cars to count it for the business. If you're opening a new entity in a year, on the year of opening, you will be able to claim organizational startup and organizational setup costs. So you should be able to deduct up to $5,000 of the business startup and $5,000 of the organizational setup costs. So please use this advantage to your advantage and claim these expenses in the year of opening a business. So kids can invest in a small business. You can pay some interest to the kids from the business and expense it to the business. At the same time, this is another strategy for individuals where the kids get a better benefit on the tax. So you can use expense with the business side and pay lower tax on the interest what you pay to the kids at the individual tax return. So retirement accounts, there are multiple different ways: SEP IRA, 401k, simple IRA, traditional IRA, Roth IRA, and defined benefit plan. Each of them have different criteria for contribution, different amounts for contribution. Just wanted to let you know that there are plans which can be specifically designed for a business where you can contribute up to $265,000 into the retirement plan pre-tax. So talk to Jyoti or talk to Pravina if you want to open a defined benefit plan. See how you can contribute a very large amount of your taxable income if you have a small business into a retirement account. So there is small differences between S corporations and C corporations versus sole proprietors and partnership. I don't want to go into the details with lack of time. But if you need some information, and if you have a sole proprietor or a partnership or an S corporation or a C corporation, and what kind of a IRA is best suited for you, please reach out to your CPA, or you can reach out to Jyoti or Pravina to help you understand what would be the best retirement account for you. Before we get into EV credit, I just want to touch base on one area. A lot of people come and ask, how do I choose a tax preparer? Right, so IRS has come out with a guideline on how to choose a tax preparer for you. So there are a few things which I wanted to just bring out. This is directly from IRS website. When you are looking for a professional tax preparer, please ensure that they have PTIN on the tax return. They have a PTIN. So this is one area where you can easily see whether they are identified and approved by IRS. So every preparer should have a PTIN who's going to sign. If they do not have a PTIN, then he's not one of the authorized tax preparers from IRS. So this is the first point what we need to look at it. And there are people who will come back and say that I'm going to get larger refund than others can. So please ensure that if they are talking about refunds without looking at your documents, without looking at your previous history, they are not the right set of people. They are, you should avoid those kind of people. Now, any tax preparer who is preparing your tax should not charge their fees based on the percentage of refund. Always IRS recommends, or IRS has a rule that a prepared tax preparer should be charged based on the not based on the refund, but a fixed fee. So if somebody is coming and saying I'm going to get a more refund for you, and you give me, let's say, a percentage of the refund I'm going to get you, they are not the right set of people who you are to work with. Now, there are a few other things which I have brought it out here. You can always go to IRS website and you can look at this. So one other thing we as Indians or we as immigrants into US needs to be aware is that you need to go to a tax preparer who knows international compliance or international rules. We have a lot of properties in India, especially from our community. We have income outside of US. We have inheritances that are possible from parents who are outside US. There are special rules when you get some inheritance. There are special rules when you sell a property outside of US. So the tax preparer with whom you're going to work should be aware of international compliance rules. Please go to a person who understands international compliance, and the best person whom you can go is who knows international compliance, and they also have an office in India or outside of US where they can help you with their tax in that country's tax filing. So please look at that, and then you choose a good tax preparer. Now, as I said, there's a time of tax filing, and a lot of people keep on calling on EV credits. So I quickly wanted to touch base on what type of credits are available for electric vehicles. Now, pollution is a key concern for every government, and the federal government has come out with some initiatives for adopting clean vehicles. So the clean vehicle credit is also popularly called as EV credit. Now, this EV credit is applicable for what kind of vehicles? People always think it's only fully electric vehicles have EV credit. No, you have EV credit for fully electric vehicles. You can claim EV credit for a plug-in hybrid vehicle, and you can also claim a EV credit for a fuel cell vehicle. Now, also people ask saying that, okay, what kind of vehicles are qualified for EV credit? So if you purchase a new vehicle which has some qualifications, we'll talk later in the next slides. A new vehicle is, has a EV credit applicable. You can lease a vehicle and then you can get a EV credit. You can purchase a used vehicle and still you can get a EV credit. Now, all of these purchases or lease should have a qualification, and we'll talk about the qualification in the next slide. Now, one other key question people ask is EV credit a non-refundable credit? Now, it's not a non-refundable credit. It is limited to the purchaser's tax liability. That means basically if you have a tax due, you will be able to utilize the EV credit. If you do not have a tax due, you will not be able to utilize. So if you have other questions on this, please put it on the chat and I will explain to you what is a non-refundable and what is a refundable credit. The general misconception is that if I'm in a refund position, I will not be able to use the EV credit. That's not the case. Even if you are in a refund position, you will be able to use the EV credit, but then you should have a tax due. That's all the requirement is there. What is the EV credit for a new vehicle? So you will be able to get 7,500 in 2023. As I said, there are some few qualifying criteria to claim the credit. The one is the income limits. So if you are married couples and married filing jointly, the income limit should be 300K. And if you are single, then the income limit should be 150K. The one limit, this is the income limit, and then you have an MSRP limit. For an SUV, the MSRP should not be greater than 80K. And if it's a car, the MSRP should not be greater than 55K. And there's a third limit, which is kind of a soft limit where the domestic sourcing requirements have to be met, which basically means that some of 50% or more of the electric vehicle should be assembled or manufactured in this. So how do you know whether this specific vehicle is meeting the third requirement? The best would be to talk to the sales agent, and they will be able to tell whether it is eligible for a EV credit at all or not. So we'll talk about the EV credit for used vehicles. It is lesser of $4,000 or 30% of the purchase price. Again, some qualifying criteria. At least it has to be 2 years old. It has to be sold by a dealer. You cannot purchase with a friend or a private dealer or a private seller and then claim the EV credit. The purchase price should not be more than $25,000. It also has an income limit, 150K for married couples. You can also claim the EV credit if the prior owner has claimed the credit, right? So it is still applicable even though the prior owner has claimed the credit, as long as it meets the other two criteria, income limits and the 2-year-old limit. You can only claim the used vehicle EV credit every 3 years. You cannot claim it every year. Only every 3 years you can claim it. Now, if you are a high income earner, is there a way in which I can still get the EV credit? Yes, there is a backdoor approach where you can lease a EV vehicle even if you are having a high income. So when you lease a EV vehicle, your income limits of 300K does not matter, and you will still be able to get the $7,500 credit. So there are a few questions again keep on coming up. So I thought I will bring it out here. Could be to the best advantages of everybody. Now, is the EV credit applicable for business? Yes, you can claim EV credit in the business as well if you buy a vehicle in the name of the business. That means your title should be in the name of the business. So it will not be called as an EV credit, and you won't get it as a EV credit of 7,500, but it will be called as a clean vehicle credit, and then it will go into the normal credit of the business. Can the credit be split between me and my spouse and claim it? Only one EV credit will be available for one person. If you have two vehicles, both husband and spouse can claim EV credit on the jointly filed tax return. Now, 2024, there is going to be some small change. Probably it's good for you to be aware. If you're planning to buy a vehicle in 2024, you don't need to file a tax return to claim the EV credit. The dealer can pass on the EV credit by reducing the total price. So effectively, what it basically means that at the point of purchase, the credit is already applied for your vehicle. So you should be able to get the vehicle at a reduced price. So FBAR and FATCA is an international compliance rule. This I will not go into detail, but FBAR is basically foreign financial accounts. You have to declare this if you have more than $10,000 in your accounts outside of US. FATCA is Foreign Account Tax Compliance Act. You will have to declare this if you have more than 150,000 or 100,000 in your foreign accounts. There are certain rules of amounts that are applicable if you are living in US, you are living outside US, you're a citizen, you're a non-citizen, and all of that. With the paucity of time, I am not going to go into the details, but at a very high level, please remember that if you have foreign accounts in outside of US, it could be in India, it could be Dubai, it could be Singapore, anywhere outside of US, and if you have a signature authority on those things, you have limits, and you cross the limits, you will have to declare them. FBAR, you have to declare more than $10,000. FATCA, you have to declare if it is more than 100,000 or $150,000. And there are a lot of people ask about FBAR and FATCA. What is included in FBAR and FATCA? What accounts I have to include? So I'll just quickly go through this. You have a savings and checking account, then FBAR and FATCA is applicable. If you have shares or in a mutual fund, FBAR and FATCA is applicable. Securities, accounts held in grantor trust, life insurance. This is something a lot of people miss. If you have a life insurance with a cash value, then you have to include that in your FBAR and FATCA. Then you have accounts held at a foreign branch of a US financial institution, that should be included in your FBAR and FATCA. So there is one other question which just I will touch base. If you have not filed your FBAR earlier, and if you want to file, is there an opportunity for you? Yes, IRS has some amnesty programs. The amnesty programs is there from 2009, and the current active amnesty program is called 2014, which it came out in 2014. It is called a streamlined filing procedure. Now, using the streamlined filing procedure, you can file your FBAR for previous years. There's a penalty that you need to pay, about 5% penalty you need to pay. You'll have to file 3 years of tax returns. You'll have to file 6 years of FBAR. If you do this, you will be in compliance. People who are in the verge of, applying for citizenship, or who are in the verge of, approval for green card, please talk to your CPAs or tax associates. They will be able to help you to file this FBARs and be compliant. Yeah, I think with paucity of time, I will stop here. I will hand it over to Vijay. You can reach out to us. Me and my colleague Ajay is also on the call here. You can reach out to me or Ajay if you have any questions.
Thank you, Kumar. Yeah, it was really very so much to compare with whatever you shared. Please post your questions if you have any, so that we can go ahead and ask them. The one is there a maximum limit for Social Security benefit one can get? I think you touched upon it, Pravina.
There is limit. There is a way the Social Security get calculated. Like if you log in there, they said, oh, if you work up to for retirement, here it is the benefit you can get. If you take early retirement, here's the benefit. There's a calculation under that. I'm happy to go through, and it's harder to go through in a bigger group. But if you hit the maximum, they will say, let's say the calculation comes out and says you're supposed to get 6,000, so they will not give that. So that's when they put the cap every year to say this is the maximum you can make from the Social Security.
Okay, thank you. And can anyone of you touch upon kids IRA contributions without the business-based earned income, where the kids are working unofficially doing chores? What are the IRS limits for annual contribution for kids? If the kids do not file any taxes?
So there's a couple of ways you can approach it. So from the financial planning and investment planning and other things. So one is, if there is a paycheck, of course, one of the best way to do is Roth IRA. You can match to, let's say they earn $1,000, so you can have $1,000 Roth IRA account, set up. You can give them the money and they can put the money in there. So the other way to think about is, we talked earlier about even the insurance, where you can make the investment. Sometimes we think about our protection and see how the kids can be protected. This could also be a way for them to grow the money. Initially, you can find it, many of us, went in that way. And then when kids grow up and they start earning, they can make the contribution, they can take over that account. Now, there are many others we can think about where they have a head start on the investment. So Kumar, you want to add anything to that?
Yeah, so for the kids, for any IRA contributions, the mandatory thing is that they need to have an earned income. If they do not have an earned income, they will not be able to contribute into the IRA, whether it's a Roth IRA or a traditional IRA. The question was more on, if the kids do the chore, will they be able to contribute, right? So effectively, if the kids do a chore, they fall under a specific category in IRS code. They will be called as household employees, and you will have to file your tax returns as an household employee. And if you file the tax return as an household employee, you can still qualify for the IRA contributions for the kids, and you should be able to contribute.
Great. Something related question also is, I'm a W-2 employee with a company A, and also have a LLC for an IT consultancy, which has some revenue. Did not run any payroll via LLC. Can we pay kids like 14 to 17 years old to reduce the tax liability from the company? Also, can I contribute a CP IRA from LLC in addition to 401k on W-2 from company?
Yes, both of them are possible, but again, I will tell that they have to talk to the consultant, their tax attorney or their CPA. It is specific to their scenario. We need to understand a little bit more to give a concrete answer on how that can be done. It can be done, but there is a way in which you need to do it to keep it compliant with IRS rules. So if it is not an S corporation, there is no need for them to run the payroll.
Okay. There's a question about global earning. If I have an income in India, I will need to disclose it in my US return. maybe get some treaty benefits depending on the situation. He says, my question.
Yes. If you are paid tax in India, you can take a foreign tax credit in US. That is one treaty benefit what you can do. Yeah, that's the main treaty benefit what you can do.
Oh, okay. So he says, my question pertains to tax situation in India and impacts on the US return. Not sure if the firm if your firm works in this area. I may have a special capital gains in India as a result of sale of ancestral property. So what is the threshold of INR to trigger taxes in India? If I do have taxes in India for property related to capital gains, will it be taxed again at US, which you mentioned? No, you can cover that, right?
Yeah, so the India taxable income or taxable gains, I think they should talk to the India CA. They will be able to tell what exactly is that. There are different calculations that will be applicable for US and India. In India, it is inflation adjusted. In US, inflation adjustment is not applicable. We will have to work with the exchange rate. So the calculations are different first. And the second, if you pay tax in India on your capital gains, you should declare the capital gains in US also, but you can claim the foreign tax credit for the tax what you have paid in India. Again, it's a little bit of a complex scenario or in a topic. Best would be to talk to the CPA, get their scenario explained in a better way and, get the calculations done.
The next one is, can we use startup deduction once we open the LLC for multiple rental income from different houses?
Yes, that is possible, but that is applicable only on the year of opening the LLC.
Okay. They're asking, Kumar, do you have an office in Michigan?
No, we do not have an office in Michigan. We work across all US 52 states. Most of the work happens through, the Teams or the Zoom. They can reach out to us, and we can have a conversation over Teams. Then we can provide that service.
Okay. And also, once the life insurance policy gets matured in India, do we have to show as a capital gain from that policy and pay taxes in the USA? Is there a way to save taxes against this?
Maybe Pravina, you want to take that, or so the life insurance
Yes.
proceeds are treated different in different countries. Maybe Pravina will be able to answer that specific to US.
Yeah. So we mainly covered about life insurance proceeds that happens in US. So that's a favorable tax treatment based on the IRS code 7702. So that's very favorable. But if you invested in India, and then if you're bringing that, so then it becomes a expatriation of the money. Then you have to look into India's tax code to see, how much taxes you have to pay there. So that's what I think Kumar, your team can do the advanced planning and help them.
Yes.
Okay. Again, about if we sell a property in India, we end up paying capital tax in India. Do we claim this as a credit in USA, and then we don't have to pay again in USA, right? That's what you mentioned before.
That is correct.
Yeah.
That is correct.
Okay, so
I would want to just add for that, basically the calculation, to answer the question at a very high level, yes, if you pay tax in India, you can claim a foreign tax credit. The amount of credit what you claim in US will vary depending on what is your income bracket in US. So it is best again to talk to the CPA to understand whether they will be able to claim 100% of the tax that they have paid or only a part of that will be applicable.
okay. Again about India, do we need to share or provide fixed deposits info into FBAR?
Yes, you need to include fixed deposit info into FBAR.
Okay. Are there any benefits for the first-time home buyers or homeowners in federal tax return?
There is no specific first-time home buyer for the federal income tax. But if they are a first-time home buyer, only one thing I can think of is basically they can take up to $10,000 on their 401k without any penalty for a first-time home buyer. That is the only federal benefit what they will have.
The next one is, do we need to file taxes for kids if they are less than 6K? Is there any age limit we should file taxes for kids?
There is no age limit if they have earned income and if their income is more than the standard deduction, it is mandatory for them to file. If it is less than the standard deduction for that particular year, there is no need to file it, but we always recommend to file it because it will establish a trace of tax filing in US. Recommended to file, not mandatory.
Okay. And then what is really kiddie tax you were talking about?
It's a little bit of a complex, or it's an involved discussion. Probably if they have more questions on that, if they have income in the name of kids coming in, probably they have to reach out to the their CPA. They will be able to explain, or they can reach out to me offline and let me understand the scenario and explain. In simple terms, if you want to put, if the kids are getting income, whether it is interest income or any other income, their tax brackets are different, and instead of the income getting taxed at, let's say, 37% of the parents, it will get taxed at 10% up to a certain limit. Again, the limits are a little bit involved. They can call or talk to the CPA and they will be able to explain.
Thank you. For college planning purposes, are the accounts in kids considered as a parent asset or a child asset?
We do separate session on college planning. There's much more is involved there. But one thing is, yes, so people always ask, should we open 529 plan? So there are definitely benefits both from tax perspective, and any growth you have, you don't have to pay taxes on that. On the other hand, when the education institutions looks at your financial needs, then that is counted towards the money that you have that you can pay. So affordability wise, you may look negative there. So it is again much involved in looking into overall situations. So whenever we do the review of the college finance, we review the whole family's finance situation first, because you should decide how much money you can afford to pay, covering your own retirement needs, your own expenses and protections you have. Then above that, it can. But if you have the money in kids' name, it's directly counted towards the assets they own. So if you're setting aside money through 529 or other means, so we suggest to use tax codes and other to your advantage, so that you maximize chance of getting scholarships and the financial aid.
Thank you. For household employees, do we need to run payroll and directly credit to their bank account?
Vijay, can you repeat the question again?
For the household employees, do we need to run payroll and directly credit?
No, not required.
For the foreign accounts, what is the threshold for taxes? I think you mentioned $10,000, right?
No, that was the $10,000 threshold was for reporting FBAR, and FBAR reporting actually 10,000, and for FATCA it's either 100,000 or 150,000. It is just a reporting. There is no tax on that. It is information reporting.
So is there a threshold for filing taxes, foreign taxes? I have only 30,000 rupees in my account in India.
No, there is no threshold on filing foreign taxes. If you have income outside of US, you will have to include that as part of US income. If you are a resident of US, so any income, even if it is $10, it is ideally correct to include.
I have a home loan in India for rental property. Can we deduct them in US?
If you declare that rental property in US tax returns, all the expenses related to the rental property, including the mortgage interest expenses, can be claimed.
I'm not sure what it is, but it says, can K1 losses offset S Corp or LLC dividend profit?
No, the K1 losses will generally be an active loss. It cannot offset interest or dividend.
Okay. How do I get back the money by selling a flat in India?
You will have to follow the repatriation process to get the money. You can get the money from India on the property what you have sold. Repatriation is again a little bit of an specialized work. So best would be to reach out to the CPA with whom they are working, or they can reach out to us. We will be able to help you on the repatriation of funds.
In that one, Jyoti was mentioning about WhatsApp group. And if you share that number with all the audience in the chat, or send it.
Yeah.
Okay.
So I put the Vijay, I put the number in the chat. I think it goes to only to the panelist. If you copy that,
yeah, I
and
can.
put
Yeah.
it in,
Okay.
That'll be great.
Okay. Hold on 1 second. Let me pass this information and then continue. Oh, geez. Okay, let's continue anyway. Is sale of inherited agriculture property repatriable?
Yes, any income or sale of property, income from the sale of property is repatriable.
Okay. Yeah, can I get a link?
Again, we need to remember that the sale of property should be in the name of the person. If the agricultural property is in a different person's name and then you sell it and repatriate, again different rules will come. So you will have to understand the scenario of the rules.
Yeah, there's another question is all the tax related information and data are done in USA itself or sent to other countries to save time and cost?
I'm not sure what is the.
How does IRS operate? I think he's asking whether the informations are all secure and only here, not sent to other countries.
If they are talking about IRS,
Yeah.
I think it's all secure and they do the processing here. I'm not sure what exactly is the question. Are they asking about our firm or they're asking about IRS?
No, that he's asking whatever information we give it to IRS in USA are all done in USA itself processing, or countries like India process your tax returns?
How IRS process, I don't know, Vijay. I'm sorry.
Yeah, I know. Yeah. Is there a age limit for us to contribute for children Roth IRA?
There is no age limit. Only requirement is that they should have earned income.
Okay. If there are grandparents in India give gifts to kids in USA, do we need to include as income in USA?
Any gift, the recipient of the gift does not need to include it in the income. But if the gifts are below, above certain amount, then you need to do a declaration in US saying that you have received the gift. But there's no tax on that gift amount.
Okay. Like with a child in college and with some earned income, do they have to file their own returns, or can I still claim them as my dependent?
You can claim them as dependent, but they can also file their own returns if they have earned income.
Okay. Is all the repatriated amount considered as US income?
Depends on what is, no. To answer the question, no, all repatriated amount is not considered as US income. If the repatriation is because of a gift from father, mother, or grandfather, grandmother, it is not a it's not an income in US. But if the repatriated amount is because of a sale of property and the property is in name of the US person, then it will be considered as an income.
Okay. Does US citizen or permanent resident need to file taxes in India if they have an income there?
Yes, they will. It will be the same scenario as what we have here. There are certain limitations, or rather than limitations, I would say there are certain minimum requirements or minimum income that Indian RBI has. So best to check with the CA whether it is applicable for their scenario and file the tax returns. To answer the question, yes, they have to file the tax returns in India if they have significant income which crosses the thresholds in India.
Okay. But as a citizen or permanent resident, you may not have the tax ID and all, right?
No, you will be able to get the tax ID. You can get for a
Okay.
non-resident PAN number. You will be able to get, and you will be able to file the tax returns.
File
You
with
can reach
that
out to,
one.
yeah,
Okay.
you can reach out to any of the CAs there. They will be able to help with an application of a PAN for a non-resident Indian.
Okay.
In India, when I got PAN card, it's easier to get. They're authorized. It's almost like a middleman, but by income tax department in India, I got it for, I think it was $45. Pretty straightforward. The process to get it. It's not that hard.
Okay. They can only get the PAN card. They cannot get the other this thing, right? The
Other, yeah.
Aadhaar card.
PAN card is much easier to get. Yeah, other is it needs documentation.
I have a land in India. Do I have to report as an asset in my taxes regularly, or only when I sell?
If it is generating income, it is recommended to report. When you sell, if there is a gain, you need to include. You need to report in US.
Whether it's a property or agriculture land, right? It doesn't matter.
Yes, whether it's a residential or agriculture land, that is true.
Just to clarify, LIC gain only shown in USA taxes only if you repatriate. But the gain, if you live in India itself, you don't have to.
I think that's what Pravina was talking about. The rules are a little bit different. In India, it might be considered as a non-taxable event of a life insurance proceeds, but in US, the same thing may not be applicable. Again, the insurance part, at best would be, I will leave it to Pravina to answer that.
Yeah, I think if it is US income, if it is US life insurance, it's different treatment than something coming from India. So then it becomes a repatriation situation. So I think these kind of very specific situation, happy to answer in a one-on-one setting.
Right, more details, yeah. So I have put your numbers in the chat. Please note it down, and then you can contact them, and then join the WhatsApp group also for, get the answers to the questions you never even thought of it. So that will help you. Next one is it advisable to file returns in India for Indian income or US in IT returns?
I did not get the question. So if the question is whether they have to file returns in India for Indian income, yes, as I again said earlier, if they cross the threshold of RBI guidelines or income tax guidelines, income tax of India guidelines, then they will have to file in India. In US, if he is a resident of US, any income that he has received outside, whether he files in that country or not, they will have to file in US.
Okay.
For example, the Indian income tax threshold, let's say, I don't remember, but let's say it's 5 lakhs. And if he has got 1 lakh of rental income in India, he actually is not required to file tax returns in India because it is less than 5 lakhs. But since he has received income outside US, he will have to include that 1 lakh in US returns.
But if he had included 5 lakhs in India, and then he didn't have to do it here.
No, any income which is earned outside of US needs to be included in the income tax return of US.
Okay.
Whether they have filed outside of US at all or not.
Okay, so the next one is, I understand if we use the funds from NRE account to buy real estate and sold later, then we just pay only the capital taxes and repatriate without issues. What if we sold inherited property and we try to repatriate after paying capital gains? Will it be added to the income in US for taxes?
Yes, it will be added to the income in US if it is an inherited property that you got it. But again, there are certain rules to calculate the gain. It is the gain that needs to get added, not the entire value of the property. Best again is a specific scenario would be to reach out to the CPA and then talk with their scenario. They will be able to understand a little bit more and then give a right answer for it. Generic answer is yes, they will have to include if there is a gain.
Okay. And just a sidebar question, Kumar, that you do India taxes also?
Yes.
Or yeah, so you can take care of both India and US taxes.
Yes, our firm does India taxes as well.
Okay, perfect. Does the land owned in India need to be reported in FBAR or a FATCA?
FBAR FATCA requires only liquid assets reporting and not immovable assets.
Okay. The follow-up question for the other one was just for your company, do you send customer data to other countries and process everything in USA?
We have all our data in US. We do have offices in India. But all our data is in US. We have a secure portal through which we access only, the authorized users will have access to the data.
Okay. Yeah, that'll help. To contribute Roth IRA for kids, can employee parents do it, or should the parents have a company to do it?
Roth IRA is an individual IRA. It is okay. Roth IRA can be an individual IRA. I think if they are referring to the regular Roth IRA, they open. It will be an individual Roth, and the kid can directly contribute. There's no need to have a company. The individual can contribute. As I said again earlier, the only criteria is that you need to have an earned income to contribute to the Roth IRA.
Correct. Okay. Yeah, it's not like you can give the money for the IRA. No. Does the estate planning cover India's property also, or do we need a separate estate planning?
So when you do the estate planning, when you talk about assets are governed by the laws of the land. So, but when we walk through the steps, we give some tips on how we can cross-reference. For example, so you're creating a will or a trust. In that, if you create a will in India, you can do the cross-reference. Courts tend to find those. It's not binding, but on the other hand, it's also useful for, let's say, you'll find
I think you are cutting out, Praveen.
on the trust, and your successor trustees, who could be your friends, relatives, or even your kids, they may not that you have in India.
The next one is when an NRI sells the land and buyers deduct their TDS, I don't know what it is, and deposits the cash to the seller's NRO account, then it gets transferred to US bank account. Then how do we report to the IRS that's repatriated and the TDS already paid in India?
So whatever is TDS is paid is actually TDS is tax deduction at source, and that is not actually the tax that they are going to pay. Okay, they will have to file the tax return in India to determine the actual taxable amount. Now, whatever they have paid to Indian government as a tax, that can be deducted in US tax returns as a foreign tax credit. Not sure on the exact question, but looks like what they are asking is if they pay the TDS, can they claim the TDS in US? If that is the question, yes, they can claim the TDS in US, but they should ensure that the TDS is equivalent to the tax that they pay to the Indian government as well. Otherwise, they can file in India, claim the tax deduction in tax refund in India as well.
Thank you. We are really running out of time and gone over by 10 minutes. But if there are any specific questions, please feel free to contact any one of them with the numbers, or you will receive the presentation tomorrow. There will be numbers in there too. Or send an email to webinars@northsouth.org and we will try to contact them and get you the answer. I don't want to take any of their time, their busy time. I really want to thank Kumar, Pravina, and Jyoti for your time and efforts and your patience in explaining things and then answering our questions. I think everyone who got attended here got benefited and then I learned something about it, but it's a huge topic, so you may have to do your own education learning. And also all three of them provide several seminars throughout the year, so you can participate. Like Jyoti mentioned, they're all for free and then they're not any sales pressure or anything. So please do that and then get yourself educated. I really want to thank all of you for coming in here, and please do give a feedback before you return when it pops up to you. And I thank you, Jyoti, Praveen, and Kumar for being here with us. This is the last webinar we are going to conduct for 2023. We wish you all a great holidays and a happy new year 2024. We will be right back next year with more interesting and important topics. Please watch for our announcements, register and attend those sessions. And thank you again, and then bye for now.
Thank you, Vijay. Thank you so much.
Yeah, thank you, all of you. And then really, this is a big topic. I figure that everybody has different situations, but you guys really did a great job explaining things. But one last request is please send me your presentations today so that I can include the link tomorrow when I send the follow-up mail to them. Okay.
Sure, Vijay. Thank you.
Thanks, Kumar, and thanks, Pravina. And Jyoti is here too, I think, but
she's here. She's in
yeah, I know she is quiet today.
Yeah. Thanks, everyone. Bye-bye.
Bye.